welcome to the April Economic Update at Beyond Wealth Advisors. I'm John Cleaver, partner and senior financial advisor, and
I'm Grant Gehring, Director of Product Research and Portfolio Strategist for Beyond Wealth Advisors.
Fantastic. Welcome to have you back, Grant, and look forward to having a good conversation today about what's going on in the world. So our title for today is Finding Opportunities Beyond the Mega Cap Stocks. So we're going to unpack that a little bit. But before we do, let's just take maybe kind of a recap, get kind of a temperature check on the current state of the U.S. economy. And we know that there's some economic indicators that continue to show maybe there's a slowdown. But are we going to approach recession or not? That's kind of the big question. So maybe unpack that a little bit as we get started.
So as expected, we are starting to see some challenges with the U.S. consumer. You've got rising credit card balances, falling savings rates, less robust employment growth. But we also have not yet seen the full effects of some of this government and corporate investments due to several pieces of government legislation that really haven't come into being yet, as far as what their spendings will be: the CHIPS Act, Inflation Reduction Act, bipartisan infrastructure law. So this spending could help offset some of the challenges that the consumer may be facing right now, and also maybe lead to some job growth for consumers, which is also a positive.
Right. Yeah. So, all right, so that's kind of the technical perspective on it. Give me your perspective on it. Like, how do you really feel about it in terms of the big picture of what we see happening? And we hear about soft landing. Is that what we're experiencing, more or less?
It's looking more like that.
Yeah.
I mean, we've been using that word recession. I feel like we've been saying that for 2 years
a long
now,
time now,
and it really hasn't happened. The consumer has been resilient. And then, as I mentioned, there's other spendings that are happening in the economy that's helping. So that's a good thing. I mean, we're glad to see that. It is true that there are some folks, though, that are probably feeling this more than others in the economy. So you have to be cognizant of that as well.
So one of the big aspects of that that's kind of taking the headline news right now continues to be interest rates. Right. So monetary policy, whether or not the Fed is going to continue to pause, probably not increase. Are they going to decrease interest rates as we go forward? They've held steady for now.
Yeah, they have.
Right. So how's that affecting the broader economy? Because I think everyone kind of expected there to be multiple rate cuts in 2024.
Right.
And now there's starting to be maybe some questioning of that. So,
right. Yeah.
So what do you see in the broader economy in terms of how interest rates are affecting that?
Well, it may actually be starting to hurt. And particularly seeing that in small business, the spending there and those loans being more expensive for small business hurts more than others. On the consumer side, of course, I mean, let's look at borrowing, mortgage rates, auto loans, credit card balance rates. Those are getting pretty high, and they are, like I mentioned, affecting people, some more than others. I mean, so we're starting to see that, though. On the positive side, though, inflation does remain elevated, but it appears to be on a downward trend.
Cooling off a little bit.
Yeah,
sure.
which of course that's the goal of the Fed, right? So
so what are they looking for? Like, is there a magic moment when they say we've arrived and we can start lowering rates, or is it that simple?
No, I don't know that it's that simple. I don't know,
we only wish it was that simple.
I mean, they're looking at the data every single month. That's just, they've made that very clear. They're data dependent. So I think they're just kind of looking to make sure that trend is sustainable. They definitely don't want things to heat back up. I mean, the labor market has surprised us a lot. And so that has kind of maybe at times caused concern. But at the same time, if the labor market remains strong and inflation falls, then we are looking at that soft landing scenario.
Yeah, it seems like that's the biggest risk, is if they cut too soon, then what do we do? Right. Because there's really nowhere else to go other than to re-raise rates. And pretty sure the Fed doesn't want to have that on their resume.
No, definitely not. Yeah, and definitely not.
So let's look back at the first quarter. I know coming out of last year, kind of the big talk was the mega cap stocks. That was kind of the title of our conversation this month. And so on the surface, it looks like that's continuing. We certainly still hear a lot about what's happening with the mega cap and the technology, and
Yeah.
of course we hear a lot about AI right now,
Yep.
and particularly in the U.S. equity markets. But it appears that there's maybe more to that story. So what's really going on as we look back on the first 90 days of the year?
Yeah, so I mean the Magnificent Seven
Yeah.
is a term we've heard a lot of. They continue to have an outsized impact on the overall equity
Sure.
markets.
Sure.
But there has been some more participation by other asset classes, and so I mean we saw some broadening, is what you would call it, of the market. So
yeah, I think you were sharing with me that of the 11 sectors, equity sectors, was it 10 out of the 11? Looking back, were actually positive.
That's correct. Only real estate was negative, and and across the broader classes, we had mid-cap growth stocks actually were the leaders of the domestic.
Does that tell you anything about what's really happening, or what? How would you?
Well,
what would you surmise from all that?
There's been some broadening. There has been some positive things with biotech, if you kind of break that down, and that kind of affects the mid-cap sector. So there's been a few areas of the market that have started to see some signs. Of course, we've had some leveling out. Tesla hasn't done as well. So some of those, the Mag 7s have cooled a little bit, but at the same time, those are very strong companies.
Powerhouses for sure.
Yeah.
So we focused a lot on U.S. equities, and that's really dominated the story even over the last maybe 18 months or so. But a little bit of a shift there, right? We've talked about global equities a few times the last few months. So anything outside of the U.S. that's got your attention right now that might be worth maybe just keeping an eye on?
Well, Japan.
Okay.
Japan has been an exciting area. They've had some record highs in their equity markets, numbers they haven't seen since 1989. So that's one bright spot in the developed markets.
Developed outside of U.S.
Outside of the U.S., correct. And of course, we're just keeping our eye on emerging markets too. There's a lot of positive signals there, and different.
Well, and I think we're starting to see this too. Some of the international countries have actually eased rates prior to the U.S. So maybe they're a little ahead of the cycle, perhaps.
Yeah, they probably are, which is good for their equity markets and their bond markets. And of course, if the U.S. decides to cut rates soon, or whenever they do, that could potentially weaken the dollar, and a weakening dollar is better for emerging markets. So lots of potential opportunities, to kind of stay tuned and keep your eye on.
Yeah, certainly pointing us back to diversification, which tends to be a consistent theme in our conversations. So,
indeed.
All right, well, let's not let equities dominate the conversation, right? So, beyond equities, I know, one of the most intriguing opportunities, and this isn't anything new, we've kind of been anticipating this as we think about rates maybe coming down, but let's talk a little bit about fixed income. And maybe why fixed income is becoming more attractive and may be attractive for a little while as another place to diversify.
Absolutely. So, one of the benefits of last year's dramatic rise in interest rates, as painful as it was, is that bonds now have some compelling income, and there's some total return potential. So if you think of this, the starting level of yield of a bond is the best predictor of the bond's total return over longer periods of time. And those starting yields right now are really high. So that bodes well. If interest rates fall as expected, then the bonds will also perform better. They'll get the price appreciation, and that'll benefit that too. Even as rates fall, with the yields where they're starting, they should be pretty attractive. So there's going to be volatility along the way. We've already seen that. I mean, the 10-year Treasury stayed a little bit higher than what we maybe thought. But expected returns for bonds over the next decade versus the previous decade are really could be substantially higher, maybe even 2.5 times high.
So you mentioned in there just briefly this idea of quality and really staying focused on not only duration, that's important, of course, but the opportunity to do that while maintaining quality. Maybe just speak to that for a second, because we don't really have to maybe reach quite as far as we had to.
Correct. That's absolutely right. So we still, as we mentioned, there's still some concerns in the economic environment that there could be some pullbacks and some concerns there. So as you look at company fundamentals and stuff, you want to just make sure they're solid. So the yield doesn't pay you enough to go out and reach for those lower credit quality bonds right now. You're getting paid really well to stay in that high credit quality. Sure. So now that's kind of where we like it, higher credit quality, and now you can start to extend your duration. I know those front end yields are real exciting. Right. But if you can lock in a higher yield for a little bit longer, if you think rates are coming down, which we think probably will, it makes sense to have those yields, locked in for a little bit longer.
Yeah, fantastic. So let's wrap up. Yep. Obviously, as we transition here already into the month of April.
That's right.
And be summer before we know it. So
that's right.
Let's just kind of recap maybe what were some good words of advice. Unpacked a lot of good things there already today, but what would be some parting words of advice perhaps?
Stick to your plan. It's important to keep a level head during market downturns, of course, but it's just as important not to chase returns.
Yeah.
And so I know we talk about this all the time. It's like a beating drum, but a well-diversified portfolio, they're tried and true to achieve your financial goals. So
So stick to your plan. Obviously, have a plan.
That's
first
right.
And foremost, and certainly continue to work with your advisor on that. From an investment perspective, you're exactly right. Sometimes as things start to heat back up or things start to get exciting, the market may start moving positively. Right. It's easy to try to think that you got to chase that.
Yeah.
And as the market broadens out, that only helps maybe the more diversified investor.
That's right.
Particularly at this time.
Sure.
And for the first time, you can actually diversify across asset class too.
Right.
I mean, we maybe haven't been able to do that as much
It's
in the last decade, but maybe more so going forward. So
stocks behaving as stocks and
bonds behaving as bonds. Okay.
Yeah.
All right.
Indeed.
Well, we like that for sure. So, well, believe it or not, we're into the second quarter, and I guess the next time you'll be back, we'll be halfway through the year.
Sure.
And so lots of great things going on at Beyond Wealth. We thank you for tuning in, and as always, make sure you find an opportunity to connect with your advisor. Be sure to ask questions, and we look forward to seeing you back next month. Thanks.